On the morning of August 7th, 2026, the United States government released a jobs report that should have sent Wall Street into a tailspin. The economy had lost 23,000 jobs in July. Economists had expected a gain of 83,000. That is not a small miss. That is one of the widest gaps between expectation and reality that traders had seen all year. And yet, by the time the closing bell rang on the New York Stock Exchange that afternoon, the S&P 500 had closed at a fresh record high. The Nasdaq Composite jumped more than 1%. The Dow added over 150 points. Wall Street didn't panic. Wall Street partied. And that contradiction, a shrinking economy cheered on by a record-setting stock market, is the story we're going to walk through today, because it did not happen in isolation. It is the final chapter, at least for now, in a year of missing data, delayed reports, and a Federal Reserve that has been trying to steer the American economy while, for long stretches, flying without instruments. Let's start with what actually happened on that Friday in August, because the details matter more than the headline. According to the Bureau of Labor Statistics, non-farm payrolls fell by a seasonally adjusted $23,000 in July. The unemployment rate held at 4%, 1% actually a touch better than the 4%. 2% economists had penciled in. But peel back that headline number and the picture gets uglier. Reporting from Benzinga broke down the composition of that payroll figure. Government hiring didn't just slow, it reversed, shedding 53,000 positions. Private employers did add jobs, but only 30,000, well short of the 78,000 that had been forecast. The labor force itself shrank by 264,000 people. The participation rate, the share of working-age Americans who are either employed or actively looking for work, slipped to 61, 4%, according to that same reporting, the lowest reading since early 2021. And then came the revisions. May and June payroll figures were cut by a combined 103,000 jobs, meaning the labor market had already been quietly weaker than anyone realized before this report even landed. It's worth pausing here on a piece of historical context, because it helps explain why this year felt different from ordinary shutdown scares. CNN Business, reporting back in early October 2025 during the first and largest of this year's disruptions, noted that history shows stock markets are usually unaffected by government shutdowns, which tend to be short-lived and leave minimal long-term marks on the broader economy. That has generally held true for decades. Shutdowns come, Washington squabbles, funding eventually passes, and markets shrug it off. What made 2025 and 2026 different wasn't the shutdowns themselves, so much as their sheer frequency and their timing. 3 separate funding lapses inside of roughly 7 months, landing right as the labor market was already showing genuine signs of cooling, meant Wall Street wasn't just missing a single report here or there. It was trying to read a slowing economy through a data feed that kept cutting out at the worst possible moments. CNBC's own headline on the day captured the mood on trading floors better than any analyst note could. Wall Street, in the network's words, reacted to a shocking July jobs loss, with one market participant calling it, on the record, a pretty horrendous report. That is not the language of people who are relieved. That is the language of people who are unsettled. So why, if traders were using words like horrendous, did stocks close at records that same day? The answer traders gave, and the one repeated across financial media that Friday, was interest rates. A weak labor market report reduces the odds that the Federal Reserve will need to raise interest rates to cool the economy, and in some readings, it increases the odds the Fed might eventually need to cut them. According to a market review published by InvestTrade on August 7th, the reaction across asset classes was immediate and broad. Treasury bond prices jumped, which pushes yields down. The US dollar weakened. Gold and silver both rallied, with silver climbing to a 6-week high of $64.57 an ounce, on pace for its best weekly performance since February, according to that same review. Big technology names bounced, with the mortgage sector in particular getting a lift, according to that InvestTrade review, as real estate stocks moved higher on the expectation that lower bond yields would eventually translate into cheaper home loans. So-called defensive and dividend-paying sectors like utilities and real estate investment trusts also caught a bid, because those sectors tend to benefit when bond yields fall. It wasn't only macro-driven trading either. That same day carried its own crop of individual company stories layered on top of the broader rally, the kind of noise that always exists underneath a big macro headline. Some semiconductor and software names moved on quarterly earnings that had nothing to do with the jobs data at all, a reminder that even on a day dominated by one number, thousands of smaller unrelated decisions were still being priced in across the market at the same time. In other words, nearly every corner of the broad market found a reason to rally off the same piece of bad economic news. That is not normal. That is a market that has learned to treat weak data as good news for stock prices, because weak data means looser monetary policy is more likely to follow. Whether that is a healthy way for markets to function is a separate question, and it is one that plenty of serious economists have been asking out loud this year. But it is exactly what happened on August 7th, and it is worth sitting with for a moment before we go further, because Wall Street was not just reacting to one data point. It was reacting to a data point that arrived after nearly a full year in which the flow of official economic information out of Washington had been repeatedly interrupted, delayed, and in some cases, put in doubt altogether. To understand why one jobs report could move markets this dramatically, you have to go back to October of 2025, because that is where this year's story of missing data actually begins. On October 1st, 2025, the federal government's fiscal year turned over, and Congress failed to pass funding to keep the government open. The shutdown that followed, according to a Congressional Research Service report published on Congress. Gov ran from October 1st, 2025 until November 12th, 2025, when the Continuing Appropriations, Agriculture, Legislative Branch, Military Construction, and Veterans Affairs and Extensions Act was signed into law. That is 43 days. According to Al Jazeera's reporting at the time, it was the first shutdown since 2013 to actually delay the monthly jobs report. And unlike the partial shutdown of 2018 and 2019, this one hit the Labor Department directly because Congress had not separately funded it. What that meant in practice was simple and, for anyone trying to understand the American economy in real time, genuinely disorienting. The Bureau of Labor Statistics stopped collecting and releasing data. The September jobs report, due out the first Friday of October, never appeared on schedule. CNN Business described it plainly at the time. Investors were dealing with what reporters and economists on Wall Street were calling a government data blackout, a phrase that shows up again and again in coverage from that period, not as some manufactured piece of drama, but as the actual term economists and journalists were using to describe a real information vacuum. NPR's reporting from early October quoted labor economists comparing the experience to driving on a winding road at night with your headlights and your GPS both switched off at the same time. That is not hyperbole. That is what happens when the country's central bank and its largest financial institutions lose access to the numbers they use to make decisions. The shutdown dragged on, and the data gap widened. By mid-November, according to CNBC, the White House itself raised the possibility that some of the missing data might never be published at all. White House Press Secretary Caroline Leavitt told reporters that October's jobs and inflation figures could be, in her words, permanently impaired, adding that policymakers at the Federal Reserve had effectively been left flying blind at a critical moment. She went further, suggesting the shutdown could shave up to 2 percentage points off fourth quarter economic growth, while Kevin Hassett, director of the National Economic Council, separately estimated the hit at up to 1.5 percentage points to that quarter's GDP. Those are not fringe estimates. Those are numbers from senior administration officials, on the record, describing real economic damage tied directly to the loss of reliable government data. When the shutdown finally ended on November 12th, Wall Street's attention didn't return to normal. It turned to a new question. When, and in what form, would the missing data actually show up? CNBC reported that agencies under the Departments of Labor and Commerce had not even posted revised release schedules in the shutdown's immediate aftermath, and that Democratic lawmakers were already pressing the administration for a timeline. The September jobs report eventually did get released once the government reopened, but the disruption had already done its work. According to the Federal Reserve's own December meeting minutes, cited in the Congressional Research Service report, the shutdown was expected to reduce real GDP growth by around 1 percentage point in the fourth quarter of 2025, with a corresponding rebound expected in the first quarter of 2026. The Fed was not guessing about whether the shutdown mattered. It was building the shutdown's damage directly into its economic models. In between the shutdown ending and the calendar turning to 2026, the Federal Reserve had to make one of its most consequential decisions of the year while still working with a data set full of holes. On December 10th, 2025, the Fed's rate-setting committee cut the federal funds rate by another 0.25 percentage point, down to that same 5 to 3, 75% range we've mentioned already, according to the Federal Reserve's own press release. It was the third consecutive cut of 2025, following reductions in September and October, and it landed even as the committee openly acknowledged in its own statement that job gains had slowed through the year and the unemployment rate had edged up through September, the last month for which they actually had a clean reading before the shutdown hit. NPR described the decision as coming from a divided Federal Reserve, and the division was real and specific. According to J.P. Morgan Asset Management's summary of that meeting, Governor Stephen Miron dissented in favor of an even larger half-point cut, while two other members, Austin Goolsbee and Jeffrey Schmid, dissented the other way, preferring no cut at all. Three members of the same committee, looking at the same incomplete data, reached three different conclusions about what to do with it. RBC Economics, in its own analysis of the meeting, put the underlying problem plainly. The Fed was, in the firm's words, still working with incomplete data, and heading into the following year's January meeting, RBC's own economists flagged that policymakers still would not have a clean unemployment rate reading for October, and that inflation data, including the October Consumer Price Index, simply would not exist at all because the shutdown had eliminated that survey window entirely. That is the environment in which the Fed set monetary policy for the entire country at the end of 2025. Cutting rates to support a labor market it could only partially see, using inflation figures it knew were going to arrive late, revised, or in some cases not at all. Freshly compiled data tracked by Finance Calendar. Com later showed just how much things shifted during that fog. The unemployment rate climbed from 0% to a cycle high of 6% in November of 2025, before stabilizing somewhat in early 2026, a swing that policymakers were, for a portion of that stretch, only able to estimate rather than confirm. If that had been the end of it, this would already be a significant story about how a single historic government shutdown scrambled Wall Street's understanding of the American economy for a full quarter. But it wasn't the end of it. It was only the first blackout. According to Wikipedia's detailed timeline of 2026 federal government shutdowns, which draws on wire and network reporting from the period, the United States experienced not one but two additional funding lapses in the first 4 months of the year, both stemming from a congressional standoff over federal immigration enforcement policy following the killing of a man named Alex Preddy by Customs and Border Protection agents. The first of these 2026 shutdowns was brief, lasting from January 31st to February 3rd, affecting roughly half of federal departments while a funding package was negotiated. The second was not brief at all. It ran from February 14th through April 30th, 76 days, and while it was narrower in scope than the historic 2025 shutdown, limited mainly to the Department of Homeland Security, it landed at an especially inconvenient moment, right as the Bureau of Labor Statistics was trying to get back on a normal publishing schedule after the fall's disruption. The underlying political dispute behind both shutdowns remains genuinely contested, and it deserves to be described carefully rather than flattened into a simple headline. According to that same timeline, the House had passed a package covering the final 6 of 12 annual appropriations bills on January 22, 2026. 2 days later, CBP agents killed Alex Preddy, and Senate Democrats responded by withdrawing support for the Homeland Security funding bill specifically, pushing instead for a short-term continuing resolution while negotiations over enforcement policy continued. A tentative agreement on January 29th to pass most of the bills alongside a 2-week stopgap for the Homeland Security Department ultimately unraveled, leading first to the brief 4-day lapse and then, weeks later, to the much longer 76-day funding gap at that single department. None of that changes the economic data story we're tracing here, but it would be misleading to describe these shutdowns purely in economic terms, without acknowledging that they emerged from a real and still unresolved political conflict, one that different news organizations and different lawmakers continue to characterize in very different ways. The practical consequence, once again, was delayed data. CNN reported on February 2nd, 2026, that the employment situation release for January, along with the job openings and labor turnover survey for December and regional employment figures, would all be postponed because of the new funding lapse. A BLS official, Emily Little, confirmed the delays in writing, saying releases would be rescheduled once government funding resumed. Axios covered the same story that day under a simple headline, "Jobs Report Postponed Due to Government Shutdown." The January employment report, according to the American Action Forum's analysis published in February, was ultimately pushed back to Wednesday, February 11th, arriving bundled together with the government's annual benchmark revision to the entire year of payroll data. That revision turned out to matter a great deal. A preliminary estimate published the previous September had already shown 911,000 fewer jobs created between April 2024 and March 2025 than originally reported, a gap equal to roughly 0.6% of total U.S. employment. When the final confirmed benchmark revision landed in February 2026, it cut the entire estimate of 2025 job growth down to roughly 181,000 jobs for the year, according to data compiled by Finance Calendar, Com's tracking of BLS releases. To put that in perspective, that is a downward revision so large that it fundamentally changed the story economists had been telling about how strong the labor market actually was throughout 2025. Investors who had been trading on the original rosier numbers for the better part of a year were, in effect, told after the fact that they had been working from the wrong picture. So, by the spring of 2026, Wall Street had lived through one historic 43-day data blackout, a 4-day funding lapse, and a 76-day shutdown layered on top of it, each one disrupting the flow of the exact statistics the Federal Reserve, banks, pension funds, and ordinary investors rely on to price risk. And that disruption arrived at the same time as something else that doesn't happen often, a change in leadership at the Federal Reserve itself. According to Al Jazeera's reporting, Jerome Powell chaired what was described as his final policy meeting as Fed chair on April 29, 2026, at which the central bank held interest rates steady at a range of 5 to 3, 75%, citing pressure on both the labor market and inflation, compounded by fallout from the U.S.-Israel war on Iran and its effect on global energy markets. Powell, according to that same reporting, indicated he intended to remain on the Fed's board until legal challenges brought against him by the Trump administration were, in his words, well and truly over, even as he stepped aside from the chairmanship. His successor, Kevin Warsh, took over from there. CNN's live coverage of the Fed's July 29, 2026 meeting captured just how unsettled that transition period remained months later. The central bank once again held rates at 5 to 3, 75%, marking a fifth consecutive meeting without a change, but this time 3 members of the rate-setting Federal Open Market Committee dissented, preferring to raise rates rather than hold them steady. Trading Economics, tracking the decision in real time, noted that markets themselves had assigned close to a 1 in 3 probability to an actual rate hike heading into that meeting, an unusually high level of uncertainty for what is typically among the most predictable events on the financial calendar. CNBC's recap of the same meeting noted that Warsh used the phrase family fight repeatedly, in 5 separate public appearances, to describe the visible disagreement inside the Fed over which way policy should move next, and told reporters that Wednesday's decision was, in his words, the beginning of a story, not the end of one. A few more details from that leadership transition are worth including, because they show just how unusual the year had already become before the July jobs report even arrived. CNN's live coverage of the July FOMC meeting pointed out that for decades, Federal Reserve chairs have traveled every August to Jackson Hole, Wyoming, for the Kansas City Fed's annual Economic Policy Symposium, an event that has often been used by sitting chairs to signal major shifts in policy direction to the world. That reporting noted Warsh may choose to stay on the sidelines at this year's gathering rather than use it to telegraph a clear course, a notable departure from how his predecessors typically used the platform. Whether or not that turns out to be the case, the mere fact that it was an open question, discussed on the record by financial reporters, underscores how much less predictable Fed communication had become during this stretch, at precisely the moment investors most needed clarity. That is the environment the July jobs report landed in on August 7, 2026, a Federal Reserve with a brand new chair still finding his footing, a rate-setting committee openly and publicly divided, a full year of intermittent government shutdowns behind them, each one chipping away at the reliability and timeliness of the very data the Fed needs to do its job. And then, into that environment arrives a jobs report showing the economy lost tens of thousands of positions in a single month, with steep downward revisions to the 2 months before it. Given everything Wall Street had already been through in 2025 and 2026, the rally that followed makes a certain kind of sense, even if it still looks strange on the surface. Investors weren't just reacting to one weak jobs number in a vacuum. They were reacting to it as the clearest, most complete, most trustworthy signal they had received about the state of the labor market in months, arriving at a moment when a rate hike had genuinely been on the table just 1 week earlier at the Fed's July meeting. A weak report took that possibility off the table, according to Benzinga's own framing of the moment, and markets responded exactly the way they tend to when a feared outcome disappears. They rallied, hard, across nearly every asset class at once. There's a survey result worth mentioning here too, because it complicates any simple story about how ordinary investors were feeling. According to CNBC's markets coverage from that same week, the American Association of Individual Investors polled its members with a special question about the Fed's decision to hold rates steady at its late July meeting. The result was not what you might expect from a crowd that supposedly wants cheaper borrowing costs at any price. More than half, 55. 1% said holding rates steady had been the right call. Nearly a third, 30. 6% actually thought the Fed should have raised rates rather than held them. Only 6% thought rates should have been cut. In other words, even as Wall Street's institutional trading desks were celebrating rate cut odds ticking higher, a majority of individual investors surveyed that same week were more worried about inflation risk than they were eager for looser policy. That's a genuine split in sentiment, and it's honest to say so rather than pretend everyone on Wall Street was reading from the same script. There's also a wrinkle in the July jobs data itself that deserves mention, because different reputable outlets describe the composition of the report slightly differently, and a fair account should say so rather than smooth it over. The Street and CNBC's own live blog reported the headline, "Payroll decline as 23,000, in line with the Bureau of Labor Statistics official release. Benzinga's breakdown described government payrolls falling by 53,000, while private employers added 30,000, netting out to a similar overall decline, with the labor force contraction and participation rate drop layered on top. Both accounts trace back to the same underlying BLS release. The difference is simply in which components each outlet chose to highlight. Where that happens, it's worth naming plainly rather than picking one version and presenting it as the only way to read the numbers. It's also worth remembering that economists had been bracing for a soft print well before August 7th arrived. Just perhaps not one this soft. CNBC's own live markets coverage from the day before the release noted that Wall Street expected payrolls to post a gain of roughly 83,000 for July, with the unemployment rate seen holding at 2%, a forecast that itself would have marked a slowdown from an already sluggish June when the economy added just 57,000 jobs. So even the good outcome economists were bracing for going into that Friday morning was a weak one by historical standards. What actually arrived didn't just miss that modest bar, it went the opposite direction entirely, turning an expected slowdown into an outright monthly contraction. That gap between a merely soft forecast and an outright negative print is a large part of why the reaction across trading desks was as pronounced as it was. What comes next matters just as much as what already happened, because the story of missing and revised data isn't finished. According to the Bureau of Labor Statistics' own July 2026 Employment Situation Release, a preliminary estimate of this year's annual benchmark revision to the Establishment Survey is scheduled to be published on August 28, 2026, the same day as first quarter quarterly Census of Employment and Wages data. Given what happened with last year's benchmark revision, the one that ultimately cut 911,000 jobs from the record and dragged all of 2025's job growth estimate down to roughly 181,000, that August 28th release is not a routine technical footnote. It is a date that could once again rewrite the story investors and policymakers think they're currently living in. The official establishment survey figures won't be formally updated based on that preliminary estimate. The final benchmark revision won't land until the January 2027 employment report is published in February of next year. But the preliminary number itself, when it comes out later this month, will give the first real signal of whether 2026's job growth has been overstated the same way 2025's was. Zoom out from the day-to-day trading, and the picture that emerges is one that affects people well beyond Wall Street trading desks. When government data goes missing or gets delayed, the people who feel it first are not hedge fund managers, who have research budgets and alternative data sources to fall back on. It's small business owners trying to decide whether to hire. It's families trying to figure out whether now is the time to buy a house, weighing mortgage rates that move based on exactly the kind of Treasury yield swings we saw on August 7th. It's workers trying to negotiate a raise without knowing whether the labor market actually favors them or not. Forbes reported back in October 2025 during the first shutdown that several private firms tried to step into the void left by the missing federal jobs data, and that most of those private estimates pointed to a labor market that was loosening, that is, weakening, even before the government's own numbers confirmed it. That's a telling detail. It suggests the underlying economic weakness we saw fully confirmed in August 2026 had actually been building quietly, quarter after quarter, visible through private sector proxies, even while the official government picture was frozen or unreliable. Think about what that actually means for someone outside the financial industry entirely. A school teacher with a fixed-rate mortgage coming up for refinancing doesn't read Federal Reserve minutes, but she absolutely feels the difference between a 30-year rate priced off a Treasury yield that assumes a healthy economy and one priced off a Treasury yield that's been yanked around by a data blackout nobody outside Wall Street was paying close attention to. A small manufacturing firm in the Midwest deciding whether to add a second shift doesn't have a Bloomberg terminal, but it absolutely feels the difference between hiring into what the government says is a 1% unemployment economy and hiring into one that, a year from now, might get revised down the same way 2025's job growth number was cut from what investors originally believed to roughly 181,000 for the entire year. Wall Street has research desks, hedge funds, and alternative data subscriptions that can paper over a few months of missing government statistics. Most of the country does not. That asymmetry, more than any single data point in this story, is worth remembering the next time official numbers arrive late. It's also worth being honest about what we don't know and what remains genuinely unresolved as of this recording. We don't know what the August 28th preliminary benchmark revision will show. We don't know whether the Federal Reserve, under its new chair, will hold rates again at its next meeting or finally move in either direction, especially with 3 sitting members of the FOMC on record wanting to raise rates as recently as July. We don't know how much of the labor force contraction reported in July reflects genuine job losses versus people temporarily leaving the workforce for other reasons. a distinction that BLS data can clarify over time, but that a single month's report cannot settle on its own. And while the shutdown history and the jobs numbers themselves come from verifiable, named sources, the underlying causes of the two 2026 shutdowns tied to immigration enforcement policy remain politically contested, and different outlets and different political actors continue to characterize that dispute in different ways. That's a debate worth following on its own terms, but it's separate from the economic data story, and it would be dishonest to blur the two together. To be clear about where everything in this account comes from, the description of the 2025 shutdown and its economic effects draws on reporting from CNN Business, NPR, Al Jazeera, CNBC, and a Congressional Research Service report published through Congress. Gov, along with direct quotes from White House Press Secretary Caroline Leavitt and National Economic Council Director Kevin Hassett. The account of the two 2026 shutdowns and the benchmark revision figures draws on CNN, Axios, the American Action Forum, and a detailed shutdown timeline compiled with sourcing from contemporary wire reporting. The Federal Reserve leadership transition and July 2026 meeting details come from Al Jazeera, CNN Business, CNBC, and Trading Economics. And the August 7th, 2026 jobs report and market reaction are drawn directly from the Bureau of Labor Statistics' own employment situation release, along with reporting and market data from CNBC, The Street, Benzinga, and Investrade's market review for that trading day. Anywhere the exact figures differed slightly between outlets, that's been noted rather than smoothed over. Wall Street didn't hide anything this year. If anything, the opposite happened. Reporters, economists, and even the government's own officials were remarkably open on the record about how much they didn't know for months at a stretch because the pipeline of official data kept getting switched off. What's left, once you trace it all the way through, isn't a conspiracy. It's something a little more uncomfortable to sit with. A financial system that spent close to a year making enormous decisions about interest rates, about mortgages, about hiring, about savings, with an incomplete and repeatedly interrupted picture of the economy underneath it. And on August 7th, when a piece of that picture finally came back into focus, showing real weakness in hiring, Wall Street didn't brace for impact. It rallied to a record high, betting that weakness today buys easier money tomorrow. So here's the question worth sitting with. When a stock market keeps hitting record highs on the back of bad economic news, month after month, is that a market correctly pricing in a more accommodative Federal Reserve? Or is it a market that has simply stopped listening to what the underlying economy is actually telling it? There isn't a clean answer, and reasonable, well-informed people watching the same numbers we just walked through are genuinely split on it. What do you think is really going on? That's it for this one. Thanks for watching.